This is where we left off yesterday, and then we had our other coins here. I think we had XRP, we had CHZ, and FTM. Pretty sure. There we go, FTM. There we go. All right. So now as the market moved a couple hours ahead since when we started, we'll look at how the current scenarios are playing out and if we should adjust something, invalidate some scenarios, add in new scenarios, and how can we interact with the market, how can we position ourselves to anticipate new positions, to anticipate new moves, new trades on Bitcoin, and then from there trickle it down into altcoins as well, and see how we can get better deals there that either hedge our main position or add into our main position and make it more efficient for us. So overall, we can look at the stochastics right now. 15 minutes bottomed out, 5 minutes stopping, 3 minutes stopping, 1 minute stopping. Okay, 30 minute is bottomed, and our 1 hour is continuing down. So our 1 hour, since we looked at it yesterday, we had a full cycle to the downside and to the upside, and now we're going further down. However, as we're cycling through the 1 hour here, the price isn't really moving that much, right? Which tells us that most likely we will go further up, because as we have some down pressure right here, the price just keeps playing around at the same area. So once we have some alignments towards the bottom, we might go further up, which probably the 2 hour, right? So the 2 hours, I'm confirming that theory, where it moved or turned around in the middle of the move and starting to go up. Our 3 hours continuing up, our 4 hour is topped out, 6 hours continuing up, 8 hour, 12 hour, right? So this consolidation phase has those larger time frames kind of turn in the middle. And our lower time frames are just, doing its thing there. They'll have a lot of cycles in that one cycle of the larger time frame. So what we're looking at here is how aligned is the stochastic with the price in the range, and how accurately can we listen to it, right? So right now, basically what we're looking at is, are the bottoms and tops of the stochastic the bottoms and tops of the price? So right now we have a bottom here, top here, top here, bottom here, top, bottom, top, bottom. What that means is that we can rely on the stochastic, that when it tops out or bottoms out, we can expect the price to turn around. And that's the entire principle of the stochastic strategy, right? Which is that we need to make sure that the stochastic is aligned, and then we can expect the stochastic, when it is oversold or overbought, that the price will follow that. And we don't do that only on one time frame, we do that on multiple time frames, and we need to make sure that they're aligned on multiple time frames, and that the multiple time frames say the same thing. So this is a prime example of that. When I look at the 15 minute, right, this bottom, for example, was a bottom midway, and that also makes sense when we look at the range itself. In the middle of the range, kind of turned around, went back, which is exactly aligned with the 15 minute. When we go lower, then this just gets expanded more, zoomed in more, and in that lower perspective, that move was all the way at the bottom here. It was at the bottom here previously as well. However, at that time, the 15 minute was not bottomed out yet, right? That was somewhere around here. So now you can see how the 5 and 15 minute, if we would just trade the 5 minute by itself, we could have longed here as well, right here, which if you're super scalping, if you're hyper scalping, you could. I imagine that the scalper could even do that. Okay, so the scalper just exited the short here, but it could have done that, right? Maybe on lower time frames it did. But this is a very, very small move. The second move here, the second bottom here on the 5 minute, is a much bigger move, and looking just at the 5 minute, doesn't really tell us why the second move, or like why the second touch spiked a much bigger move to the upside than the first one. But if we look at a higher time frame, we can exactly know why, because the first move didn't do anything on the 15 minute, but it turned around here on the second move. So that's why we had a bigger spike, because that spike was a turn of the stochastic, not just on the 5 minute, but also on the 15 minute. Now, if we zoom in further down to the 3 minute, it's just going to be zoomed in more. So obviously that move is going to be here. If we look at the scalper, still didn't have a long there. We're probably not going to have the long there. And then the 1 minute obviously is zoomed in the most. So that just tells us overall what's happening on the 15-minute time frame and lower. Right now we just bottomed out on a 15-minute, which I would assume that we did on a 5-minute as well. Another thing that's great is that when we look at multiple time frames, right? So on this 15-minute time frame, the stochastic is bottomed out, but it's going further down, right? So we don't know if the price will just continue moving further down and catch it, like it traps our stochastic at the bottom, or if we start going further up. However, when we look at the 5-minute into more detail, we can see that the stochastic started traveling to the upside quite a bit. So then we can anticipate that the 15-minute is going to start traveling to the upside as well, because the 5-minute broke this move on the downside, and so the 15-minute will continue to the upside, and we don't have to, or like there's a much lower chance of the price to keep breaking to the downside, because our lower time frame told us. Gave us the information. So that was until the 15-minute. Let's look at the 30-minute here. 30-minute is aligned with the 15-minute, which is very good. If we saw this like 1 hour earlier, which by the way, I haven't been looking at the market. I'm trying to look at the market only on these calls. So that way we will have a very representative performance of how it looks like when you look at the market once a day. Schedule your trades, schedule your theories, and then just let it play out and come back the next day. So the 30-minute was bottomed out here with all our lower time frames aligned with that. With the 5-minute giving us the signal of going further up. So this would be a really nice long here, a very easy long, especially because we're at the bottom of the range already. So a long setup here with a layer of orders to the bottom of the range, which we would have filled like 1 or 2 of. So we'd have a better average entry probably around here, maybe even a bit lower actually, because this candle was pretty low. So we'd hit more. And this would give us a pretty nice scalp long here, which I would assume, let's see if the 15-minute caught that. The scalper, yes it did, it longed right here, which is good. I like to see that the scalper catches the moves that I see myself. So that's a 30-minute. The 1 hour is still going down, but the 1 hour is something lagging. So, but it still has ways to go. So what this tells me, right, my anticipation here is that based on a 30-minute, we will go up, so we'll go to the top of the range, maybe gets to a higher level here, but we will still not break to the upside because our 1 and 2 hours, they still need to kind of finish their move. So what we're gonna do is we're gonna have one more cycle on the 30-minute. The 30-minute will top out, bottom out, and then we'll go further up. That's how it looks like. And then when we go out to the higher time frames, they're kind of toppy. So at this point, the 4, 6, 8 look more topped out, and then we have our weekly and monthly that are topped out. So this is something definitely we want to look at. So that's why it's good that we still have our short possibilities here together with the long possibilities. And I do not imagine that we will keep going further without at least having one more touch at 38, 37K, and that's where our entries would, start happening. our scalping long here from before, we would have been holding that for a while now and entered some shorts as well. And the result of that is basically that we're hedged, almost fully frozen. Actually, no, profitable from the entry of the long, right? Together with the entry of the short. So in this area between these two levels, we're profitable, no matter what. And if we go to the upside, we're profiting from the long. If we go to the downside, we're profiting from the short. The short is a little heavier than the long, meaning that if we go to the upside, over time, we will get a bigger loss than we have a profit from the long, because we're hedged a bit heavier to the downside right now, just because we're waiting for our longs at the lower levels to hit, which can be, in a couple of days. We don't know when. But this is what we're looking at right now. So our three scenarios, actually all of them are still viable. The only thing that changed is that we hit some orders on that short. Let me try and adjust the short here to hit when we hit the orders. And we still have our long here. I don't know where the take profits are here, but we're still trading this long here. So we're basically hedged in profits. If we go further down low, we will hit a stop loss on our long, and we'll start adding into longs later on here. So really what this is a preparation of a big move, either to the upside or to the downside. And if it would happen right now, then we would exit our short at a level where we are almost breaking even from that long. But after we exit that short, the long will continue producing profits as we go to the upside. If we go to the downside, we will have heavy profits from the short, exit this long, start adding in our orders on this bigger long. If we break that, we will exit those orders on a stop loss and then just continue profiting from this long. So essentially what we have is we have three separate players here, three separate games that we're playing. Number one is this instant long here, which can happen. Number two is a short, and number three is a long that we're anticipating lower. And wherever the price goes, upside, consolidating, or downside, we are set. If the price would just range around this level, then we would have our short orders here, our long orders here, and we would just range around and just deliver the profits from one side to the other. So that's our fourth scenario, is just sideways, which works because our short entries are in this range, a bit lower. Our short entries are in this range, and our long entries are in this range. So as we bounce around this range, anything in this range, we're profitable. Anything above this range, we're profiting from the lower ones as we exit the upper ones, and anything below this range, we're profiting from the shorts as we're exiting the longs. So as long as this adds up, we're essentially, when you add this all together, you will be profitable no matter, and this is something that I can leave right now because the orders are in, the stop losses are in on all three. So whether we range, go up or go down, the result, so if we just keep ranging around, we'll just be profiting, and I will have to reload those orders manually. But if we go to the upside or to the downside, whatever happens here, the result of that will basically be that we're essentially break even here, and then wherever we break to the upside, to the downside, we'll be profiting off of that. So wherever the price goes now, without my interaction, we will be positioned on the profitable side. The only thing that would be negative for us, a negative result for us, would be if we would hit the stop losses one after another at the top and bottom, which physically is close to impossible when I think about that. So we're set up pretty well. And this is when you're ranging. So when you're in a range, this is how you want to trade. And people don't do that because they're scared that they might miss out on a trade. And if you do, so what? You'll have millions of these opportunities. But when you're in a trade, when you're in a range, right? Let's say you're here right now in time. You know, range. You have a top and you have a bottom of the range. So the best way that I like to trade is I set up orders at the top of the range. I set up orders at the bottom of the range. And the stop losses of these orders are just going to be right above and right below. Let's make this red. Right above and right below. Let me remove these lines. Right above and right below. And this works when you're ranging. So as you hit the bottoms, you go into longs. As you hit the tops, you go into shorts, right? You take some profits off of the longs and you enter some shorts, and then you go down, then you go up, you go down, you go up. The thing is that if you break to any side, you will take with you the longs. In this situation, as we broke to the upside, you will take with you the longs that you had, that you took when you were at the bottom of the range. So and you're hitting a stop loss on your short. So on your short, you're hitting a stop loss of around, I mean, this was sloppy from me. I haven't really calculated this. Like, obviously it needs to make mathematical sense, but this is like, let's say this is 3% of your 3% to a stop loss here. And with your long, you're in at this point 11%, right? So the result of that is that you will be outside of the range to the top side, taking the price, taking the long almost 18, 19, 20% here, while you were set up to do this in in both scenarios. So because you entered your short here and you went right here and you took some profit off that short, if the price would just break here to the downside, you would hit your stop loss on your long, which would be 4%, and you would take with you your short, which would be 12%. So either way, and you need to make sure that the stop loss, you hitting the stop loss with the full position, is not a bigger loss than you adding in on the other side. But if that adds in at least to break even, then whichever side you go with your breakout, you will be in the right position and you'll be making profits. So basically, you can, I don't know, call it a QC grid, wherever you want to do, right? But if you apply this QC grid on any range, the number one, you'll be making profits off of the range. But whichever side you break out to, it doesn't matter. Like, you can hit this, like we could probably do a bot to do this, to reset the orders, take profits and stop losses, because you're basically grid trading here. But you can just apply this thing, throw it on a range, and whichever side you will break out, you'll be making profits. So whenever there's a consolidation in the market, right? So let's say there's a range here, and we don't know if we go up or down. And there's, you look at a bunch of discords and you look at a bunch of forums or whatever, a bunch of influencers in there, 50% of them is bullish, 50% of them is bearish. We don't really care, right? We set up our grid, and whichever ones of them are right does not matter to us, because the result of this range is going to be that we will be positioned in the right position, right? And it works the best when you catch a range early, because what you do is while you're in the range, you will have here, for example, 1, 2, 3 hits of your, well, 2 from here. You have one good short here and you have one good long here, where you just or make some profit just because of the range being a range and going from up and down. And then you break further up, you hit one stop loss, but that's covered from the trade from the other side that has, done a much bigger move. So your stop loss here would be what, say 4% once again, and your profit would be 13%. So that 13% covers the 3% of a stop loss, right? At least to break even. So then when you keep going further up, you're essentially in this long. And what's the entry of this long? It's insane, right? If someone would try to catch this move and get this entry, you would be like, this is impossible. But it's not, because what you were doing, you were range trading. You did not define this level as the exact low that the price will be at. You set your range here to the top and the bottom of the market or of the range, and you were just trading that range as long as it happened, and then whichever side the price breaks out to, you will still have the opposite side trade, right? So that's the theory behind it. And obviously, if you combine this with looking at a different stochastics and getting a good idea of the likelihood of the breakouts, then that's going to help you a lot more. So that will just improve the efficiency of the overall profitability of the strategy. So really, we're grid trading until we're not. But we don't try and bet which side we will break out to. We just know, because it's a core market fundamental, that when we're ranging, at some point we will break out to one direction. So what we're trading or what we're betting on is not the fact which way we will break out. It's just the fact that we will break out. And in order to do that, we need to make sure that we need to position ourselves in the market, and we need to do it in a way where we're profitable, we're not going to lose money. How do you do that? You do that by, let me just draw here. You do that by creating a range and entering your long at the bottom of the range, entering your short at the top of the range, and then when you're in the range, you will guaranteed make profit, right? So, because if you were in two positions here, right, if you were hedged, if you had longs here and shorts here, and you can do that in hedge mode on Binance, for example, or you just set it onto different coins. You can do Bitcoin and ETH, same thing. So like you can do longs on Bitcoin and shorts on ETH, for example. But when you're in this range, you have profits from both positions. So you're basically locking, if your position size would be the same on both longs and shorts, then you would be locked. Your profit would be always the same, no matter where you go in this range. The profit would be exactly the same because you're fully hedged. You basically froze your profit, is what you did. No matter in this line where you are, you have the same profit. right? So the main thing is to manage to do this, because now you guaranteed a profit. And if you would just keep this setup, these two positions as they are, you would just have the same. Let's say you're up 5% here, and no matter what happens, even if the price would go up here, even if the price would go down here, assuming that you have the same position on both sides, you will still be up 5%, whether you're on 19K, 30K, 60K, or 1K. You're still up 5% because the profitable trade will make exactly as much as the negative trade will lose. You will just keep that difference, which is 5%. So we're basically just betting on our core market fundamental of ranging, and then we'll break out into one direction or the other. So what we'll do is we will set a stop loss. Obviously cannot be too tight, because that's when you can get messed up. But we'll essentially set our stop loss below here and above here. And as we break to the upside, we will basically unhedge ourselves. We will unfreeze our profits, because now we know which direction we're going. We're betting on the fact that we're either ranging or we're moving to another range. And then we just take this trade and we move it. We had our short stop out at a very small area, but we had our long profit the entire way to the stop loss. So we are profitable here. We're still 5% profitable here. And then now our profit starts growing as we broke through that range. Let me know if that makes sense, guys. So we're basically trading the range. We're setting up orders. The important part is that your long entry, your average entry is at the bottom, and your average entry for the shorts is at the top. When you do that, then you're basically hedged, and whatever happens with the price, you have a delta profit. So then you can wait until the move finally happens, and then you can unlock your hedge and keep profiting in that move, rather than betting on one side and being right or wrong. This way, you don't care about which side it goes to. That's a fool's game. What you do is you bet on the fact that the market is going to behave the same way as it always does, meaning you have a range and then you have a break out of that range. And whichever way you break out, it does not matter. It's just the fact that you break out, and when you do, then you will just follow that move. So that's essentially the, what did I call it? QC hedge strategy. Let's just call it that. So and this is essentially the same situation here. Our short is ready to hit orders here. Our longs are ready to hit orders here, right? So the outcome of this will be that we'll be hedged in this move, and then whether we break to the downside or we break to the upside, we will then hit our stop losses, which will unlock our hedge, which will then move us to the start where we will start profiting off of that. And as long as we're in here, the current situation right now, our entry on our long is somewhere here, 39.848, right? So we're slightly profitable on that. Our short entry is 40.163, so we're profitable on that. We're slightly heavier on the short than we're on the long, so we're not fully equal. The reason that is because our long was basically in the middle of the range. We're anticipating for the price to come lower, and that is where we would actually fully hedge and have the same position to the upside and the downside. So right now we're still in this long, and this long would essentially profit into our short positioning. And other than that, we're just waiting for the price to start ranging to the upside and downside or break out. Either way is fine, because right now we already are positioned in both directions. So we're in the long and we're in the short. So if we would just right now, if we would just break to the upside, we would be slightly negative. We would have a slight loss once we hit the stop loss on the short, because we're slightly stronger in the short than the long. But as we would just continue further up, we would make that back pretty quickly, because we're still in that long. So this way we are positioned into both sides, and we don't have to think about, are we going to go up, are we going to go down? We just have to think about, are we ranging and are we going to break out of that range, which is a much simpler thing to predict, because it's a core market fundamental. The core market fundamental is we're either ranging or we break out of the range and we move to another agreed upon price, and then we range there. That's a core market fundamental. A core market fundamental is not, we will always go up. That's not a core market fundamental. So we cannot bet on just a long, because even if we're good, even if our strategy is good, there's times where we will be wrong and we will go short. So by being able to looking at this objectively and be like, okay, I might have a bias if we go up or down, but my bias is not what makes me money. What makes me money is trading probabilities. So I will just set up both scenarios, up and down and sideways, by the way, which is the most profitable scenario if we just go sideways, because we still have that breakout coming at some point. So anything that we do by doing sideways, we're literally just making extra money before we break out. And then when we break out, we have our stop losses hit our stop losses take us out of the hedge, and then we're just in the profit in the move. And it does not matter if it goes to the upside or to the downside. That's the good part, right? So how many times did it happen that you had a trade and then there was just like a huge wick to the down? You were long, then there's just a huge wick to the downside and you get stopped out a lot. Well, that's not good, is it? However, if we're positioned in both sides, then assuming you have a 5% hedged, right? So no matter what happens, you're up 5%. You're 5% hedged, the price moves down, the stop loss triggers, there's no liquidity, so the stop loss triggers like 3% lower, something like that, which would kill you, right? Murder you if you were just in a long with a stop loss. But it does not matter, because that 3% lower is a 3% higher profit of our short, right? And then all that happens is we just unhedge a bit lower. Whereas if you were just in a long and you have a volatile move to the downside, then you get stopped out, and you get stopped out 3% lower. That's a 3% more of a loss. And if you're leveraged, then good luck. So this is also a hedge or a way of solving liquidity issues and solving volatility issues. If you have a stop loss and there's no liquidity and you get filled like at a really, really bad price, well, that's not going to happen if you're hedged, because the fill's still going to happen, but you're not gonna incur extra losses in that, if that makes sense. Right. So this is basically. This is basically how we're trading this, and this is my favorite way of trading anything, because I'm not betting on a side. I'm not betting on, am I going to go up or am I going to go down? I'm just betting on the fact that we're either in a range or we're going to break out of the range, and I'm going to position myself, and that's where the skill really comes in, of being able to position yourself in a way where you're positively hedged, meaning that you need to enter at the bottom of the range at the long and enter at the top of the range at the short. But the best way of doing that is literally just looking at where's the range, and then just put your orders at the top and bottom of the range, and then just let the price play out, and it will just happen by itself. And then when that happens, you're positively hedged for as long as you want, when you touch the bottom and the top of the ranges, you will just transfer some profits, right? You will enter a little more, and then you take profit there. You'll enter a little more in your short, you take profit at the bottom, and so on and so forth. You just trade that range with a small percentage of your account, and then once you break out, you will exit your losing position, basically, which will unhedge you, right? So it will unfreeze your profits because you're in profit right now, and then you will continue having profits. So that's the idea of it. That's the idea of this hedge scenario right here, and that's how we have it positioned out on Bitcoin. We're still on long here, waiting for the short to fill more, or we can just go further down. We're in the short already, so as we go further down, we'll stop out on our long. We already took profits, by the way, but we'll stop out on that long and enter the long lower, because that's the actual range. Right now we're in a small range, right? So we want to do the bigger range, and yeah, then we're just gonna let the range play out. If we break out, perfect. If we stay in the range, perfect. So right now we covered the scenarios. Are we gonna go up or down? That's fine, right? Either way is fine, which that is a big question for many traders, right? Because they get biased towards one side. If you're not biased, and if you're set yourself up for both sides, well, guess who's going to be guess who's going to be right more often? The guy that bets on one side, or the guy that bets on both sides, or girl. And so that's one thing. That's one way of looking at both scenarios. And the other way is that, okay, well, we can break out, but we don't have to break out. So if we do break out, we unlock our hedge and we make profit. If we don't break out, we'll just range trade and we'll make profit, right? So doesn't matter if we go up or down, or if we range trade or break out, we make profit in all four scenarios, right? Which is the possibilities that can happen in the market in general. You either in a range or you break out of the range, and you do that either to the upside or to the downside. And we're positioned because we're hedged in both sides, and then we will unlock our hedge whenever the breakout happens. If the breakout doesn't happen, we'll just range trade and we'll just carry some of those profits to the upside, to the downside, until whenever we break out, and then we'll do whatever we do in our breakout. Which, by the way, if I go to sleep and the breakout happens, I am already positioned. The stop loss will get triggered, so I will get unhedged automatically. So I don't need to be there for that to happen. The only thing is, unless you have a bot to do it for you, when you're range trading, you will have to reload those orders for take profits and for entries. That's the only thing. But we can probably we could do a bot for that. I'm sure we could. I could probably do it within a few hours, but yeah. And then we were still looking at our Solana position here as a additional hedge, additional short, which is something that might play out, might not play out, which is a side situation from Bitcoin. And in here we could set it up the same way. We could range trade and set it up the same way, but right now we're focused on Bitcoin, to be honest. Because we got into the hedge. Yesterday we were not in the hedge yet because we didn't hit that level to enter the short, but now we are. So yeah, that's essentially it on Solana. We can look at the stochastics as well. Looks still mostly topped out to me, but the lower time frames need to align to the top side, otherwise we might have a break to the upside. XRP didn't hit our entry here. Chiliz actually flew past our entry, and FTM didn't hit our entry. So Chiliz could have been the short to the other side, really, but this is literally what happens. It's just part of the strategy. And yeah, so that's basically it. That's my outlook right now. I can tell you in the Discord exactly what my percentage is. I'm pretty sure that once we hit the stop loss on the short, because we have a different sizing on the current long and the short, I'd be down like 2-3% or something like that. And then if we go the same distance, so to like starting from like 42k, we'll be profitable again on the long. If we go down, we'll be plenty of profitable in the short. And if we hit the stop loss on the long, we'll still be profitable on the short. And we will add in our actual long here. And I think based on a calculation, we would lock in around 5% profit if we fill long orders here right now. And that 5% profit will basically be the same as we're hitting more orders to the upside and downside. And then whenever we break to the upside, we would hit a stop loss on the short, which would still be 5% profit, same thing. And then we'll start profiting the second we exit the short, same thing to the downside. So that's a good setup on a hedge. All right, guys, that's everything right now. I'm just gonna leave it as it is. I'm gonna save it, and then tomorrow we'll look at it again and we'll see how this aged. I'll just take a quick look here, the scalper, see what it's doing. And yeah, that's basically it. Tomorrow we'll see it just like this. And we'll continue playing out our scenarios. And this will probably be like a multi-day series of doing one single trade on Bitcoin. And we'll see how we end up in the maximum amount of profits that we can. All right, guys, that's everything from my side today. If you guys have any questions, let me know. And I hope that this helped a little bit. I hope that you learned a little bit about hedging and grid trading and the benefits of it. The important part is that you do it correctly. So you absolutely need to make sure that you will enter at the tops and bottom of the ranges. Because if you don't, yeah, this is a little advanced here, but I think that you guys can handle it. And if you master this, then this will change. Instead of trying to guess which way the price is going to go, you don't care. You will just bet on a core market fundamental, and then you can just watch other people be happy or depressed because the price went against them, whereas you are positioned positively on both sides. So it's very, very important that your entries are good here, because if they're not, and let's say you enter your short at the bottom and you enter your long at the top, then you lock in, you hedge in a loss, right? So no matter where the price goes, you have the same loss, right? Because the delta is negative, the difference. So it's important that you have a good entry on your long and a good entry on your short. That's why I am ready to exit my small scalping long here and re-enter lower, so my hedge position in this range is good. The reason I haven't exited now is because in case we just go up a lot. In that case I still want to be in the position, right? But ideally, we actually want to go down here, and this is the thing, right? So either way the price goes now, you're happy. You're happy if you go to the upside, right? Because you're profiting. You're happy if you go to the downside because number one, I'm profiting off of my short. Number two, I filled my long orders and I hedged myself. So now I'm guaranteed to profit, right? So that's yeah, looking at it this way is very good. All right, guys. If you guys have any other questions, let me know. Other than that, I will see you guys in the Discord.